Brandon Rogers, Trent Bradshaw with Mind Your Money, and a market update for today is December 6th, 2021. Two main things we want to cover today: talk about the recent volatility that's going on in the market, and then also talk about some minor changes we made to the portfolios intra-quarter. So we'll take a look at both those. All right, Trent, so when we're looking at the market, it's obviously been a very uncomfortable time, I'd say, in the past week or so, ever since the day after Thanksgiving, I'd say, when Omicron popped up on the scene. But again, what else are some things that are going on, I guess, that have this market volatility still here, but it's a big seesaw, it seems like.
Well, in addition to the uncertainties surrounding COVID and the variants that we're seeing, you just mentioned it, we're also looking at the Federal Reserve starting tapering program, which means the 120 billion a month that they're printing, they're going to start easing back, targeted to be about 15 billion on a monthly basis that they'll pull out of the system. They may do it quicker. We had another report where they may accelerate that. But the goal is to get to next summer, 2022, and basically not be printing any monies into the system. But what that's going to do is tighten the money supply. When you tighten the money supply, it's just like increasing interest rates. Normally, that's correlated to a negative market. And if you look at it historically, you can go back over the last 10 years, there's a perfect correlation of when the Federal Reserve is actually pumping in money into the system, and we've got quantitative easing, Operation Twist, a lot of different titles that they used in the past. But right now, it's just the simple treasury purchases and also mortgage-backed securities at that 120 billion a month that they're wanting to pull back down. Because if you think about it, that's 1.4, 1.5 trillion on an annual basis. It's massive. So once you pull that amount of money out of the system, it's definitely got to have some impact on the market in general. But overall, a positive note to that, and that's why we made some of the changes, which you're going to discuss, has been the fact that the macro data that we're getting, some of the positive growth, or let's say improvements in multiple data points, is really talking about a regime change here, going from a reflationary stance where we have higher inflation, higher growth, to where we potentially could get in an environment where we've got higher growth and lower inflation. We've already started to see it. You look at some of the commodity prices like lumber, which we've talked about before, and other commodity prices have come down substantially over the last couple months. So the fact that that's occurring, we potentially made some adjustments today. We took some of those inflationary holdings out, which, talk a little bit about that.
Yeah, so the swaps, I guess, if you want to call them that we changed, we stepped away from energy, which again was a great performing sector this year, but energy we took out in the financials, so think about banks, right? So we took those two out, replaced them with basically consumer discretionary. We'll put up some examples of some of those names. Amazon, Tesla are really the top two main holdings into that.
Right.
But we've got a diverse approach there. And then also housing, right? So again, as Trent just mentioned, you see just the price of lumber. I mean, you can go to Lowe's and just see how lumber has come down dramatically. So I think the OSB boards used to be like her highest. I think I remember seeing them were $70-some a sheet. I just checked it recently. They're down to about $18 a sheet now. So again, you can kind of see those pricing coming down, and that's why we're trying to make the shift right here in the middle of the quarter. But we're also going to have our regular reallocations potentially, or going to be first part of January as well.
Yeah, they may not change. Well, we may stay with the current allocation that we've got, but we'll be back with updates. But on the construction index side of the equation, the reason we're doing this, some of the data that we've gotten, hey, there's potential of 50 to 60 million millennials coming into the market. The housing situation that we've got right now, there's no inventory. So the construction index, which we added in there today, should be a very, very big benefactor of that. So what we're looking at is potentially holding that for at least the next quarter or so to see what kind of reaction we get going into the new year.
Yeah. But as always, like I said, we'll keep you posted on any changes. Again, we'll do another at least allocation update in the first of the year. Unless something changes between now and then, we don't foresee it, but we'll definitely keep everybody up to speed on that. Let us know if you've got any questions. Our website should be backing up and running soon. We've had some issues there, but that should be coming soon. So again, anytime you've got any type of questions or whatever, definitely reach out. Brandon Rogers and Trent Bradshaw with Mind Your Money.